Welcome back to my channel. Today we are diving into the essential concepts of money weighted and time weighted rates of return. As part of our CFA Level 1 learning series on quantitative methods, we are continuing with the third learning outcome statement, that is money weighted and time weighted rates of return. So far in our series, we have covered two key LOS. In the first LOS, that is interest rates and time value of money, we have decoded interest rate and their determinants. In the second LOS, that is rates of return, we explored various return measures such as holding period return, arithmetic return, geometric return, and providing a detailed comparison. If you haven't caught up on these crucial topics yet, be sure to watch those videos first. You can find the links in the description below. Now, let us deepen our understanding as we explore the third LOS focusing on money weighted and time weighted rates of return. Before we delve into the topic, let us consider an example. Imagine a value fund that delivered returns of 20%, minus 12%, 25%, 16% over the last 4 years. Now let us introduce two investors, investor A and investor B. Both of them initially investing rupees 1000 in this fund. The fund compounded annual growth rate, that is geometric mean, is 11.24%, resulting in both investors seeing their 1000, that is rupees 1000, grow to rupees 1531 by the end of fourth year. Both investors would receive the same return if they follow this pattern, that is 11.24%. Now let us adjust our illustration slightly. Investor A decides to add at the end of year 1, that is the beginning of year 2, plus 500. Conversely, investor B withdraws rupees 500 at the end of year 1. So we will take 500 from this fund. Similarly, in the year 3, investor A withdraw 500, investor B add 500. After this transaction, the total amount for investor A after 4 years is 1444, while investor B's total amounts to 1618. Why does this happen? Simply put, the timing of cash flows impacts their return. Now let's explore the reasons. Investor A contributes rupees 500 at the start of year 2, that is just before the fund suffers a negative return of 12%. Conversely, investor B withdraws rupees 500 at the end of year 2, coinciding with the fund's 12% negative return, resulting in a loss of only rupees 84 on the remaining rupees 700. In the third year, investor A withdraws rupees 500 while investor B adds rupees 500 during a period of positive fund return, that is 25%. Consequently, investor A realizes a gain of 249 rupees only on his total capital of 996. Conversely, investor B gained rupees 279 on his total capital of 1116. Investor A made a fresh investment at an unfavorable time when the fund experienced a negative return, which reduced his overall return compared to the fund's performance. On the other hand, investor B added rupees fund when the fund was performing well, that is during a positive return period, which increased its overall return compared to fund's performance. Thus, investors A poor timing of investment reduced his return related to the fund, while investor B's well-timed investment resulted in a higher return than the fund itself. Timing of cash flows can significantly impact investment return, as we will further explore in this discussion on money weighted and time weighted rates of return. Whenever we have these kind of cash flows, that is cash addition and withdrawal, we must use money weighted return. Usually, investors who regularly add and withdraws money from their investment tend to use money weighted return. Money weighted return is similar to IRR, that is internal rate of return, and bonds yield to maturity, that is YTM. Bonds, YTM, we will learn in detail in fixed income. Now let us see this IRR. IRR is the discount rate at which the sum of present value of all future cash flows will be zero. Here, we need to consider the fund flow from investor perspective. When the investor put the money into the fund, it is a cash outflow for him because he is investing, he is paying from his pocket. So that is a cash outflow for him. When the investor withdraw the money from the fund, it is coming to him. So it is a cash inflow for him. Now let us consider their cash flow. This is investor A. Initially he started with 1000. Then at the end of year 1, he add 500. At the end of year 2, he withdraw 500. At the end of year 3, there is no transaction. Finally, at the end of year 4, he withdraw all his investments from the fund. Similarly, this is the cash flow of investor B. He is also started with 1000. At the end of year 1, he withdraw 500, and at the end of year 2, he is adding 500. Year 3, there is no transaction. Finally, at the end of year 4, he withdraw all his investment from the fund. Now let us calculate IRR using this equation. For the time being, no need to worry about this formula. We will learn this formula in time value of money in detail. We can calculate IRR using our BA plus calculator. This 1000 as CF0 is the initial cash flow. Then first year cash flow, that is CF1, and it is CF2. This is CF3. This is CF4. Similarly for investor B also. Now let us calculate using the calculator. Now let us calculate IRR using BA plus calculator. We have to use this CF function. Press CF, there is some value, we have to clear the screen by second function and clear work. Now we can input our values. CF0 is minus 1000. I enter, then CF1 is minus 500. Then F1, it is nothing but it is a frequency. For example, we have to enter 500 for 3 years, we have to put 3 here. But we have only 1 year only, so we will keep it 1 as it is. Then the second cash flow, second year cash flow, it is plus 500. Then third, this frequency again 1. Third cash flow is 0, we have to enter 0, otherwise it will not take the value. Then frequency 1, and fourth cash flow, all his investments. This plus. Now we have entered all the cash flow. If you want to check, okay, you have to check whether you have entered correctly or not. Okay, yes. Now press IRR, then press CPT, that is compute. You get 8.639. This is the IRR for investor A. We can calculate this using Excel also. First we have to record the cash flows. Initially, his investment is 1000. That is cash outflow for him. This is CF0. Then at the beginning of year 2, he again put 500. This is CF1 because end of year 1 and beginning of year 2. CF2 is plus 500. He withdraw the money, so it is a cash inflow for him. Then CF3, there is no transaction. Then finally CF4, all the money will be withdrawn by the investor. So this is the cash flow for the investor. So we got to calculate using IRR function. Simply put IRR and select all the cash flows. There we go. You got 8.64, which is money weighted return for the investor A. Similarly, we can calculate this for investor B as well using calculator and verifying the results with Excel sheet. Money weighted return is crucial from the investor's perspective because it accounts for the timing and amount of cash flow into and out of investments. When evaluating returns, specifically from investors' viewpoint, it is essential to calculate the money weighted return. Conversely, when assessing a return from the fund manager's perspective or aiming to evaluate the performance objectively, time weighted return is preferred. This metric disregards the impact of investors' cash flow, ensuring a fair assessment of the fund manager's investment decision independent of external factors like investor withdrawals or additions. Therefore, time weighted return is essential for accurately evaluating portfolio performance under such conditions. The question may not instruct you to calculate either money weighted or time weighted return. Instead, it might ask for the return to be calculated either from the investor's perspective or the fund manager's perspective. In such cases, it is very important to interpret the perspective given and then choose the appropriate return measure accordingly. Let us explore the same example to understand time weighted return. In our value fund example, the time weighted return is calculated as 11.24, representing the geometric return of all four returns provided. Each year, the fund generates returns based on the capital available at the beginning of that year. Here is how it breaks down. Let us add one line as capital available at the beginning. Year 1, the total capital available is 1000. The fund generate a return of 200. The closing amount will be 1200 by year end. Now let us assume investor withdraws rupees 1200 and add 500 and reinvest 1700 at the year beginning. The fund generate a return of minus 204, then the closing amount will be 1496. In year 3, investor reinvest only 996 because he withdraw rupees 500. Return generated on this 996 is 249 rupees. The total amount will be 1245. In third year, the total amount will be 1245 because there is no transaction. The fund generated return of 199. Finally, we get 1444. Now we can calculate annual return as fund value at the end divided by fund value at beginning minus 1. This is 20%, minus 12%, 25%, 16%. So we have to calculate the geometric mean of these returns to find out the time weighted return. You can see 11.24 is the time weighted return. In time weighted return calculation, we compute the return before any significant cash flows occur in the fund. Portfolios are typically valued daily to prevent additions or withdrawals from affecting the return. Assuming no transactions are allowed within a quarter, the portfolio is valued at the end of each quarter before any such cash flows occur. Let us consider the same example. Instead of yearly returns, let us assume these are quarterly returns. We calculate the annual return using holding period return formula. If you haven't watched the holding period return video, please click the link above. Let us calculate now. This 1 plus R1, that is the first quarter return, multiplied by 1 plus R2, that is second quarter results, multiplied by 1 plus third quarter results, 1 plus fourth quarter minus 1. So this is the annual return. So this equation gives the holding period return over 1 year, representing annual return of the fund. Let us consider the example given in CFA curriculum. Let us note down the facts given, then we can do the calculation. On 1st January, the Wallbright fund had a market value of USD 100 million. So the initial value is given. During the period 1st January to 30th April, so the first period is given, that is from January to April. The stocks in the fund generated a capital gain of USD 10 million. So let us record this value. Initial value is $100 million. The period is from January to April. There is no addition, there is no withdrawal. So the capital available at the beginning will be 100 million. Then the capital gain is 10 million is given. On 1st May, the stocks in the fund paid a total dividend of $2 million. All dividends are invested in additional shares. This dividend of 2 million is for the first 4 months. So we will put at the end of April. This is as good as May beginning because all dividends are reinvested. So what will be the value of the fund at the end? It will be sum of initial capital, capital gain and dividend received. So it will be 112. This will be the opening value for next period. Let us read now. Because funds performance had been exceptional, institutions invested an additional $20 million in Wallbright on 1st May, raising the asset under management to 132 million. Now there is an addition of 20 million. So the total fund value will be 132. That is what they have given. That is 100 million initial value, then 10 million of capital gain, 2 million of dividends that is reinvested, and 20 million additional fund. On 31st December, Wallbright received a total dividend of $2.64 million. So the next period will be May to December and they have received a dividend also. Let us put that. This period is May to December. They received a dividend of 2.64 million. The fund market value on 31st December, not including the 2.64 million in dividend, was 140 million. That is, the fund value is 140 million without dividend. It means the total fund value will be 142.64. So it means the capital gain will be 8 million. Total addition is 10.64. So the total fund value will be 142.64. So we have the capital available at the beginning of each period and value of the fund at the end of this period. Now we can calculate the periodical return. Then from that we can calculate annual return using holding period method. Let us calculate. Value of the fund at the end divided by capital available at the beginning minus 1, 12% is the first period return. Similarly here also 8% is the second period return. So now we can calculate the annual return 1 plus 12% multiplied by 1 plus 8% minus 1. So 21% is the annual return, that is the time weighted return for the Wallbright fund. Now let us calculate the money weighted return from the investor's perspective. Money weighted return, as discussed, represents the internal rate of return considering the funds additions and withdrawals. We need to structure the cash flows into equal periods. Again, I'm telling equal periods because when we calculate time weighted return, we have just considered two periods. First period contains 4 months, second period contains 8 months. But here in money weighted return, we have to divide into equal periods. So we can divide like this: January to April, first 4 months will be the first period, then May to August will be the second, and September to December will be the third period. So initial cash flow is $100 million. It is the outflow for the investor. From the investor perspective, it is a cash flow because he has invested $100 million. We put minus 100. Then CF1, it is the beginning of period 2 or end of period 1. First May, there was a fund addition. It is the cash outflow for the investor. So we put minus $20 million over here. There is no cash flow in the beginning of period 3 or end of period 2. So we will put 0. And finally, the end of period 3, because we have only 3 periods, the cash inflow for the investor is 142.64. We can just derive from this time weighted return cash flow. You can see initial cash flow is 100. That is a cash outflow for the investor. So we put minus 100. Then second one, this is fund addition by the investor, minus 20 we put here. There is no cash flow in the second period. Then finally the investor get all the money, that is the inflow for the investors. Now we can calculate using the IRR formula or we can use the calculator also. We will check here. So 6.28% is the money weighted return for the investor. Now we have finished third LOS in the learning module 1, that is money weighted and time weighted return. Moving on to the fourth LOS, we will explore annualized return measures and continuously compounded returns, highlighting their respective applications. Stay tuned for the upcoming video.